Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are mixed here. Let's welcome in markets and data editor, that would be Jared Blickery, to break down the headlines. Jared, what are you seeing in the markets?
Thank you, Josh. Mixed is a good description here. We got the Dow Jones down, and I'll show you the intraday price chart. We started out in the green roughly, but we've been chopping around. That's a whole lot of chop going from most of the day to the 11 a.m. hour. Here's the NASDAQ composite, still holding on to gains of 44 basis points, about 0.4%. But you can see the gains were much higher earlier in the day, so most of those being given back. We'll see what the last hour holds. S&P 500, very similar chart, up about half of what the NASDAQ is, 0.2%. Meanwhile, the S&P 500 equal weighted index, I think this is a good day to bring that up. That's where every stock gets one vote. That is in the negative here, and that is just telling us that there is not a lot of breadth. Some of the mega caps, some of the bigger stocks are really what's holding or propelling the NASDAQ to those gains. Meanwhile, the Russell 2000 small caps down about 0.3%, and we got to take a look at what the bond market is doing. 10-year Treasury yield, that's almost flat. That's not even 1 basis point to the upside. That is at 4.13%. 30-year, that is at 4.75%, up 1 basis point. So the bond market really not causing too many hiccups here. And one more thing I'm going to show you on this page, the VIX. Now you can see it is lower just ever so slightly from yesterday, but I've been showing this 2-month chart out. We are in the midst of the second VIX spike we've seen in about 5 weeks. The first coming around that China tariff scare in the mid-October. Now when it comes to sectors, tech finally rebounding after 2 days of leading the market down. That is up 0.6%, followed by industrials. Those are the only two outperformers. Materials, financials just barely holding on to some green there. To the downside, energy, the biggest loser, that's off about 1.5%, 1.5%. Then staples and real estate and utilities, healthcare. Basically the bottom row, except for XLC, that's communication services, are the defensive ones. So I would call this a moderately bullish setup to the day. When you take a look at the NASDAQ 100, you're going to see some green, some red. Alphabet is in dark green there, up 3.25%. Broadcom up 3.5%. Nvidia right before earnings up 2.25%. We'll take a look at semiconductors in a second, but equal weight. This is where every box is the same size here. You can see there's more red than green. So back to that thesis that we are not having the greatest breadth today. Now here's the Dow, and aside from the mega caps, you can see some of the leaders here, J&J, Caterpillar, Cisco, each of those up more than 1%. I'll throw Sherwin-Williams into there too. So leading to the downside, we got Boeing down 2.5%, Salesforce very similar, and Merck, that's down 2% as well. Want to show you some of the fringier parts of the market just to show you that risk appetite is not the highest right now. Here are the meme stocks, and some of the big ones are green. But again, if I sort by equal weighted performance, almost the whole board is red there. And you can see a similar scenario talking about fringe markets when we show you the cryptocurrencies. Bitcoin has cracked 90,000, forget 89,000, it is now 88,000. So just kind of slicing through a bunch of big support levels and minor ones as well. So we'll have to see. So far, the bigger names holding up this market today.
All right, thank you, Jared. Appreciate it. The Federal Reserve releasing the minutes of its October meeting, revealing the division over whether the slowing labor market or sticky inflation is the biggest threat to the U.S. economy. Joining us now with the details, we got Yahoo Finance Fed correspondent Jennifer Schonberger. Jen, what do we know?
Hey there, Josh. These Fed minutes really bearing out what Fed Chair Jay Powell said at the podium 3 weeks ago, that a rate cut in December is not a foregone conclusion, really seeing that division borne out in these minutes. They read that, quote, in discussing the near-term course of monetary policy, participants expressed strongly differing views about what policy decision would most likely be appropriate at the committee's December meeting. Now, while most members of the Fed thought it would be appropriate to continue cutting rates towards a level of neutral, that's a level on the Fed funds rate designed to neither spur nor slow growth, they didn't think it necessarily had to be done in December. Therefore, perhaps a prudent pause, if you will, in December before continuing on. Now, there's another contingent in which several officials also said on the flip side that they could see continuing to cut rates in December if their economic outlooks play out as expected. And still, there were some who thought it would be appropriate to hold rates steady through the end of the year. Certainly, we have heard Fed commentary over the past 3 weeks, and we can put faces to some of these takeaways from the minutes. Boston's Susan Collins, Dallas Fed's Lori Logan, as well as Kansas City Fed's Jeff Schmidt, all in favor of holding rates steady. So some faces to that contingent. I also thought it was interesting that there's division over how restrictive rates are here. Some thought that with the rate cut that we saw at the last meeting, rates are still restricting the economy, while others say, nope, policy is easy right now because the economy remains resilient and the stock market's up. Financial conditions look good at this point. The other thing that stood out to me is that most participants thought that given the elevated inflation right here, that if they were to cut rates further, that could entrench inflation further and risk what they call persistent inflation. And that could create misinterpretations by the public and markets that the Fed is abandoning its 2% inflation target. So those were the major takeaways from the Fed minutes. Separately, Josh, we have learned the Labor Department has reported today that they will not be releasing the October jobs report. They will go straight to the November jobs report, though that will be released on a delayed basis on November 16th. And of course, tomorrow we will get the September jobs report. So lots of jobs reports to keep in line here.
Yeah,
Josh.
investors quickly place their bets on what that means, potentially for a rate cut as well. Jen, thank you. Appreciate it. Nvidia reporting third quarter earnings after the bell. The results could be make or break moment here for not just Nvidia, but that broader AI trade here. Talk all things Nvidia. We got none other than Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, obviously this all comes after that broader tech sell-off we had seen earlier in the week. It's only Wednesday, although with an Nvidia day, it feels like it's been a week in of itself. But right now we're waiting for the company to report. This will be their first report since they had crossed that $5 trillion market capitalization mark. It was the first company ever to do that. It's since slid back below there. But for the quarter, we're expecting to see earnings per share of $1.26 on revenue of $55.2 billion. Now, that would be an increase of 55% and 57% respectively. We're also expected to see data center revenue of $49.3 billion. Gaming revenue used to be its big business, $4.4 billion. That's basically a drop in the bucket at this point for Nvidia. But obviously, the big deal here is whether they beat and raise or they just come in line with expectations. We've seen after a number of Nvidia reports, well, they beat expectations, they maybe raise slightly, and then we see the stock decline slightly afterwards. So we'll have to see what happens there. But there's been this kind of ongoing conversation about our AI companies, Microsoft, Meta's overbuilding. Will there be enough demand for that build out? Microsoft, Google, Amazon, they've all said that they're capacity constrained, so they need to continue to build, but that continues to be an ongoing topic of discussion. And if we see Nvidia perhaps beat by too much, that might inflame those discussions even further. If they don't do as well, then it could be a discussion of maybe we've hit the max of building out. And so it's going to be this kind of back and forth between investors after the earnings. We'll just have to see how the numbers come. Maybe they'll just hit a sweet spot in the middle.
You know, Dan, while we have you, my friend, we just did announce, as you know, this partnership with Polymarket. So now the official prediction market of Yahoo Finance. One of the bets they have up right now, Dan, is what will Nvidia say during their next earnings call? I'll ask you, Dan, what do you expect from that call? What are you going to be listening for?
Yeah, I mean, there's a number of different phrases or terms you might hear. Obviously, gaming is basically going to be discussed. They have their gaming arm. They have to discuss it. Their chips are found in the Nintendo Switch 2, as well as their own gaming chips. They frequently talk about hyperscalers. They make up about 50% give or take, of their revenue each quarter. So we're going to be on the lookout for that as well, just to see how those companies are digesting Nvidia's chips as well as their own. Then obviously there's going to be discussion about tariffs and President Trump. They announced, or we saw news today, that semiconductor tariff is on pause for now. We'll have to see how that keeps going. And then, there was supposed to be discussion of whether or not they would be able to sell back into China. That was supposed to take place during President Trump and President Xi Jinping's conversations in South Korea. Nothing really came of that, so we're not expecting anything along those lines. And then obviously, automation is something that Jensen Huang talks about often, whether that's automating factories, vehicles, things along those lines. He generally refers to that as physical AI, though, so we'll have to see if he goes with a different phrase this time around.
All right, Dan, thank you. Well, all eyes are on Nvidia's earnings out in just about an hour now, and while expectations we know always high for the chip giant, the recent rockiness in the AI trade adding extra pressure to this evening's release. One strategist I spoke to this week, Marta Norton from Empower, she called the release a macro indicator at this point. Joining us with their takes on Nvidia and its importance to the broader markets are Jeff Schulze, ClearBridge Investments Head of Economics and Market Strategy, and José Torres, Interactive Brokers Senior Economist. Welcome to you both. Jeff, I will start with you. Nvidia earnings on deck. I think you could call this, Jeff, I think it's fair to say the most highly anticipated print of the earnings season, $4.5 trillion market cap. How important is this print, Jeff, for the broader market?
Well, as Nvidia goes, so does the market, and Nvidia's market cap is now bigger than the entire energy, materials, and real estate sectors in the S&P 500. So this is obviously going to be a very important release, and we're going to get some visibility on what their outlook is for revenues and guidance for 2026, and whether or not this AI CapEx trade can continue. Obviously, the market has had some choppiness here, and one of the concerns is the sustainability of that AI CapEx trade. But I think more importantly, this could be a release that finally gets the market moving higher, especially considering that Nvidia has really struggled in the month heading up to this earnings release, where that traditionally hasn't been the case.
Jeff, one question for investors, I want to get your take on this, is this kind of circular web of AI deals, which Nvidia is a part of, right? In other words, you have this small group of companies relatively, and they're kind of moving money between each other, and then they commit to using each other's products and services. There are some investors, Jeff, who've kind of thrown a yellow flag on that. They say, well, hold on a second, is that all kosher, or is that kind of artificially inflating this market? I am curious to get your take.
Well, we did see this circular financing back in the late 1990s, and that obviously ended in tears. But I think an important difference today is that when you look at the AI CapEx cycle, it's nowhere near the magnitude of investment that you saw during the 1990s. And a lot of the investment is being funded through free cash flow generation or earnings rather than debt financing. So I think that this cycle still has a long ways to go, and eventually it will lead to overcapacity and tears, but I don't think we're near that point.
Jose, I want to bring in you here as well. Now, you're looking through this through a different kaleidoscope, right? Economist. This AI trade and trend and theme, which Nvidia is the face of, how important is that at this point, Jose, to the broader U.S. economy?
Well, it's huge, Josh. Great to be here. The market is now getting closer to becoming a barometer of the economy, because the lower income and middle income consumers, they're having a lot of trouble. We're hearing that on the retail earnings calls. And it really is the high income consumers that are really driving consumption forward. So if you have a market correction, those folks, their behavior could now become dictated by their portfolios. Everyone's looking at their phones and looking at their portfolios. If they see their values go down, all of a sudden they're going to start dropping their discretionary activities. So it's huge. As far as for the AI theme, are these capital expenditures in AI, are they going to deliver long-term capital returns? Or is it going to be lackluster? That remains to be seen, but that's why the market here is waiting for these results to really choose a direction, really sandwich here on the S&P 500. We've recovered from the 5% drawdown from the high yesterday, and then we tried to get above the 50-day moving average today, but we didn't. So we're right there at those two pivotal points. The market's waiting for direction. I think a beat and raise blockbuster guidance, that can take us above the 50-day moving average. And don't forget, tomorrow we have that September jobs report as well, which which can move rate cut expectations right now at around the coin flip.
Let me ask you, Jose, there was a good piece by Greg Ip in the Journal. I thought of you when I read this week. He says, the most joyless tech revolution ever. He says, AI is making us rich and unhappy. He says, discomfort around AI helps explain the disconnect between a solid economy and an anxious public. You agree with that as an economist? Is that the disconnect?
To an extent, we're starting to hear employers more and more, they're starting to realize we're not hiring as much because we're adopting AI. So that's really hampering labor market performance. And we heard the Fed minutes,
let me ask you, do you think it's making people anxious?
I think so. Yeah. I think so because a lot of college grads, they're expecting to get into the labor force. They have great grades, great marks, great recommendations, and then they're having trouble getting in because instead of maybe 20 spots, there's only 10 because AI is doing a lot of the work. So I think that's generating some anxiety.
Jeff, switching gears a bit, we did get the Fed minutes today. My buddy Peter Bukvar saying they show, he says, a high level of disagreement within the committee on what to do at that December meeting. What do you think, Jeff? What's going to happen?
Well, the hawkishness of the FOMC minutes today was not a surprise. Powell alluded to this in the press conference just a couple of weeks ago. But I think, although the hawks have been very vocal over the last couple of weeks about pausing to reassess until you have more data, Waller spoke earlier this week, and the title of his speech was The Case for Continued Rate Cuts. And Waller obviously is a very important voice on the FOMC. And right now, Fed fund futures have it around 30% that we will get a Fed cut in December. I think that number is probably closer to 50-50. So I do think it's a coin flip, but I think the key takeaway for investors, even if we don't get a rate cut in December, I think there's a very high likelihood we will get one in January. And when you look back to 1980, you've had a soft landing rate cutting cycle of 75 basis points or greater, which we will have if we do get a rate cut over the next two meetings. The forward cumulative return of the S&P 500 after that first rate cut has been 48%. So although there is a lot of optimism embedded into equities right now, should the economy continue to move forward and the Fed cuts one more time, I think a lot of people are going to be very surprised at where the market stands back when we look back in 2 years from now.
Jose, the November jobs report we learned today, that is now delayed until December 16th. So that means the Fed doesn't have the October or November reports when they meet. How does that, if at all, in your opinion, impact odds of a cut?
Well, I think they're going to be relying a lot more on the private sector sources. We have ADP, we have Revelio.
How well do those fill in the gap, though?
I think they do a pretty good job.
They do?
Yeah,
Okay.
I think they do a pretty good job, especially when you aggregate them all together, and they're all saying the same message. We're having a deceleration, we have job losses, we have some, layoffs are starting to tick up modestly. We're still in the low fire environment. As far as the composition of the Fed, it looks like right now the hawks are outnumbering the doves because you got Myron, you got Waller, like Jeff was saying, and you also have Bauman. They're looking for cuts, and then you have the majority of everyone else, Josh. They're talking about keeping it steady, and inflation's here at 3%. So that's another pivotal number, because if you start going up to 3.1 versus going down to 2.9, it's that psychological 2-handle versus 3-handle that can really influence the Fed's path moving forward. As far as the economy going forward, I think that if Nvidia doesn't perform well this afternoon and we get the numbers, we could fall into a correction in equities and we could have a slowdown going into next year. Our forecast market expecting only 0.8% growth for the fourth quarter of this year. So that's something to watch as well, Josh.
All right, no pressure, Jensen Huang, no pressure. Jose, Jeff, thank you both. Appreciate it.
Thank you, Josh. Great to be here.
Thank you.
Coming up, we're going to take a closer look at how you can trade Nvidia's earnings. That's coming up next.
Nvidia earnings are dominating the headlines, and on today's Stocks in Translation, we're taking a look at how you can play Nvidia stock based on historical probabilities. So first up, I've shown this chart many times before, but basically, if you were to buy Nvidia stock right before earnings and you held it for 1 day, 1 week, 1 month, 1 quarter, 1 year, this is the return that you might have expected over the last 10 years. So we're looking at the median returns over the last 40 reports, 10 years. You can see not much going on. 1 day later, 2%, 1 week later, 4%, 1 month later, 2%, but the odds start going up when you hold for longer periods of time. At 1 quarter, you're looking at a 14% median return. And then this is really the focus here. After 1 year, you basically saw a doubling of the stock price. Now I want to show you, these were the median returns. I want to show you the win rate or the percent positive for the same time period, 10 years. So 1 day holdings, that was positive 60% of the time. 1 week, 65%. 1 month, 58%. Anything under 70%, by the way, I consider to be subpar because stocks tend to go up. When you get to 1 quarter, and remember, that's when we were getting that 14% return, then we see the odds shoot up to 77%. And 1 year later, you are up 83% of the time. So it just kind of shows you that you want to be in that buy and hold mode unless you are a very, very nimble trader, because some of these shorter time periods are barely better than a coin toss. Now I want to show you what the experts are doing. So this chart goes back a few years. In white, we have Nvidia stock price, and in green, we have the median Wall Street price target. And as you can see, it's usually above. That is, the price target is usually above the price. And sometimes Wall Street is playing a game of catch-up. So you'll see like right in here a few times that the stock price actually exceeded that Wall Street target here too. And the last time we caught up to it was probably a couple quarters ago, and you can see there is a rather big disparity between the target and the price. Over the last 90 days, since that last earnings report, Nvidia stock has basically done nothing. It's just about flat. Meanwhile, the average price target, or median price target, is up to 237. That is a gain of 19% over that time. So the big question is price going to once again catch up to those price targets, or is there going to be a big disappointment? And is that price target eventually going to catch down to the stock price? We'll have to see about that one, but history says, at least over the last 10 years, and especially the last few years, that Nvidia stock probably catches up to that target. Now we're going to take a look at post-earnings moves. Now these are just moves, and we're talking about range of trading. We're not talking about up or down. So the average daily move in Nvidia stock any given day since its last earnings report is 3.4%. Now what the options market is implying, that is expecting over the next day after the earnings are announced tomorrow on Thursday, what is the return, or what is the range going to be? 7%. So basically more than double that. And then I took a look at the last 10 quarters, so that's 2.5 years. What was that post-earnings day move? Well, that was actually 10.7%. So we have seen a reduction in volatility over the last few quarters here with respect to Nvidia stock. So that's something to keep in mind. We'll probably see above average volatility in the earnings reaction, but that's also going to be probably maybe double what we've seen over the last 90 days on those non-earnings days. Now I want to get into the return. So this is how much money you would actually make. Post-earnings average return over the last 10 quarters, 3.6%. Now, 6 of those were wins, 4 of those were losses. So of those 6 wins, it was a positive a return of 9%. And of those 4 negative losses, those were 4.5% on average. So you put it all together, Nvidia stock is kind of a tricky one to play sometimes, especially in the short term. No doubt it has been a long-term winner for a lot of investors here.
Stick around for market domination after the break. This year has been filled with uncertainty, from tariff rate changes to a record-long government shutdown, and now AI bubble fears. I spoke to a panel of experts at Yahoo Finance's Invest event, ADP's chief economist Neela Richardson, editor-in-chief of Investopedia Caleb Silver, and Truist chief investment officer Keith Lerner about their outlooks for 2026.
So the labor market has really been holding hands with the consumer this year, and actually for the last several years after the pandemic recovery. We have a relatively strong labor market. It's been called low hire, no fire. I think it's been static. It's been less dynamic than we're used to, but we haven't seen a lot of outflows or inflows. What we have seen, though, is that the hiring momentum has slowed quite a bit since the beginning of the year. So yes, the consumer is still well supported by a functional labor market. That means they're going to keep spending, but you can already see from the tape you rolled, there's an uncertainty cloud over that spending. And that uncertainty is strongest for low-income, low-wage consumers. So even though we have an economy and a consumer that is strong enough to keep that economy growing, it may not be strong enough to keep the job creation flowing and that hiring momentum. Yes, strong enough to spend, but not strong enough to get those mom and pop businesses to hire yet another worker when they're already facing a lot of uncertainty.
Keith, I want to bring you here as well. Your outlook for the economy next year, what do you see, Keith?
Well, a punchline is an uptick, and it's a modest uptick. As you just discussed, it is a two-speed economy. It's a two-speed stock market as well. But the way we're thinking about things and why we expect at least a modest uptick is based on three things. One, we do expect the Fed to cut rates modestly over the next year, so that should be a positive. We have this tax bill that was passed. We should see some incentives and some positives in the first quarter as far as for the consumer and also businesses. And then hopefully we'll also have a little bit more clarity on tariffs. So you put that all together, that suggests to us a modest uptick, maybe a little bit above 2% as we move into next year.
Caleb, I want to get you in as well, because you have a unique insight, Caleb, into the retail investor. When you're surveying all those fans over in Investopedia, how would you broadly characterize investor sentiment right now based on your survey work? I mean, is it optimistic, Caleb, cautious, downbeat? What do you see?
Yeah, cautiously optimistic is how I would describe it, and why not? We are seeing many all-time highs already so far this year. We do have the wind at our backs in terms of corporate profits, and we've been seeing that play out in the earnings numbers, but they're also concerned about the underlying economy. At what point does a potential weakness in the economy translate into weakness in the stock market? So far, they're still dancing in opposite directions, and that's kind of, they usually move in different directions or usually not down the same path. But right now they're wondering, is this going to last? And they're worried, just like some of the people you talk to, about their own personal finances or about their neighbors' personal finances. In the stock market, their assets have done very well. We got more millionaires than ever. We got more 401k millionaires than ever. We have more retail investors invested in the stock market than ever. That's good. That's a way to generate wealth. But maybe at some point, this diversion between the two, the economy and the stock market, catches up to the stock market and affects overall mood.
Neil, Keith brought up the Fed there. You say something interesting. You say the time for easy answers for the Fed is over. What did you mean by that, Neil? What makes this environment more tricky?
You know, I call it the muddled middle. It's easy to know what to do when inflation is very high. And it's easy to know what to do when there is very low inflation, or going back to where we were, before the pandemic, when the problem the Fed was facing was too low inflation, not too high inflation. Imagine that.
Right.
But it's hard to know what to do when both sides of your mandate are active and you're trying to thread a needle through a very narrow hole. And that's exactly where the Fed is today. They have projections that inflation stays above their own targets for the next 2 years after being above target for the last 4 years. And consumers are very sensitive to price increases in a way that they weren't 10 years ago. So you add that with the slowing momentum, still a pretty solid labor market, but a slowdown in that hiring momentum, you get a very tight spot for the Fed to maneuver going forward.
I've seen some economists now, let me get your take on this. They talk about the labor market. I think it was Ed Yardeni, and he said, the issue with the labor market, he said, was on the supply side, boomers are retiring. They're not easy to replace. You got stricter immigration policies. On the demand side, he pinned a lot on AI. A lot of bosses, he thinks, are thinking, I can reduce headcount but boost productivity. His point was, Dr. Ed, he doesn't see how a Fed cut addresses any of that. What do you think?
I think that is the key issue. There is a conflation of things that are short-term in the making in the business cycle and structural, whether it is AI exposure and impact, demographics, immigration, uncertainty. These are structural changes to the economy, and the Fed acts short-term. That's why at ADP we actually started producing just 2 weeks ago a weekly index of employment change. That way we hope that investors can have a real-time perspective of what's going on in hiring, because there is so many things happening all at once.
Keith, turning to that Fed meeting next month, it's interesting. Some of our central bankers, when you listen to them right now, it doesn't sound like that cut's a sure thing. Some of them seem to be saying, listen, that 2% target, it's a target. It's not a suggestion. I just wonder if next month you don't get the cut, how would the stock market react, do you think?
Well, right now the market is pricing in about a coin toss, and I think that's probably about right. And to your point, they have scar tissue from the inflation before. They're in a tough position. So I think initially you could have a bit of a hit, and you probably would see that more in the small cap and more of the interest rate sensitive areas. But I also think that for this market, the most important thing isn't whether the Fed cuts in December or January. I really think it's about corporate profits. And what we've been saying all this year is that the North Star of this bull market is corporate profits. As the stock market has made a new high, corporate profits has followed. Now we have to see, is that sustainable? A lot of that is driven by tech and AI, but we have seen that broaden out as well. So I overall, again, I think the interest rates moving down matter on the margin, but it's not the make or break for the bull market. I think profits ultimately will be, and if we do see a little bit of an uptick or this muddle through that you just discussed continues into next year.
Caleb, when you survey folks about the Fed, I'm interested, what feedback do you get? Are they fans of Jay Powell? Are they critics?
Largely in support of how the Fed has handled monetary policy and want the Fed to remain independent. That is one overall sentiment that they think most of our readers, who are individual investors, have. They really want the Fed to remain independent. They think that's super important. But to the point that these guys have made, it's not really necessarily where the rate goes from here. The rate is the rate. I think it's about corporate profits. And when you think about how investors are perceiving the stock market right now, the most important metric probably is revenue per employee. And that is driven by AI and other advancements. But if you look at the best performing stocks in the market, they have the highest revenue per employee. Look at Nvidia, it's $3 million per employee for that company. And when you look on down the list, that's what's important. That's what's been driving the stock market and stock market returns. That's not a great sign for the labor market long term, if that's what we're going to be seeing going forward.
Keith, every bull market has a theme. This one's been AI. Caleb, they're talking about Nvidia. I feel like I have to ask you, and it's a top of mind question for so many investors. I'm sure your clients are asking you, AI boom, AI bubble. What do you tell them?
Yeah, so you're right. Every bull market has a dominant theme. AI and tech is this market's bull market theme. The biggest question I'm getting is, are we in a bubble? And our answer is no. When we look at the data, at least that's what the data tells us. So what are we looking at? Well, there's a couple of factors, but one is valuations by themselves. Valuations are rich, but if you look at the S&P technology sector, we're trading around 30 times. That's expensive, but during the bubble, it was 50 times. Another statistic to take away the valuation component is just saying price. Like a bubble has a momentum aspect to it, especially towards the end of it. On a year-over-year basis, the technology sector is up about 30%. During the bubble period, it was up more than 100%. I also started my career in the mid-90s, and when people would call up and they wouldn't know the stock name, they would be saying IOM or JDUSU. Most of my questions today are we in a bubble? That wasn't a question back in the late 90s when people were leaving their job to be day traders all day. So it doesn't mean we can't have a correction. We had a big run. We're seeing a little bit of nervousness. But ultimately, I think that underlying trend for tech is still intact, but we're taking a breather. We're seeing some rotation, and there's just some concerns. But I do think money will ultimately come back to tech because that is where the secular growth is.
Coming up, we'll take a closer look at what the options market is expecting from Nvidia's big third quarter results. Stick with us. Qualcomm making a major push into the Middle East, announcing plans to open a new engineering hub in Saudi Arabia as part of a broader wave of AI partnerships in the kingdom. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, this is basically an engineering hub, as you said, that they're designing. It's in addition to the 200 megawatts of AI accelerators that they're rolling out. They're basically NPUs, neural processing units, tomato when it comes to this kind of stuff. But that's really what's kind of going on here. And so they were at the dinner last night with SPM and the president and seemingly everyone else in Silicon Valley. And so it's part of their effort to diversify on their own as far as business goes, but it's also, as you said, part of this larger effort by big tech to get into the Middle East with AI in particular, because there have been these blocks on which countries can get chips and which can't, Saudi Arabia being part of them, the UAE as well being on that list. And now with President Trump seeming to ease up on those restrictions, a lot more companies are trying to flood in. So Nvidia is working together with xAI to build a data center there. They're also working with OpenAI, which is in the United Arab Emirates, trying to build a new kind of Project Stargate over there, or a Project Stargate-like setup. And so Microsoft also trying to get in there with its own AI data centers. And we're going to continue to see, as companies gain more access to areas, this kind of push. And there is, though, concerns. Those blocks were in place for a reason originally. There's fears that if
I meant that was a point you brought up in your piece, Dan, which I thought was interesting, which was
every piece I read.
Of course. I'm just one thread that's interesting. Fair. Many, I would say. Saudi Arabia's push here, the kingdom's push, as you highlighted, get its hands on these AI chips from American companies. That is raising questions.
Yeah, there's concern that because of their tight relationship with China, then that China will somehow gain access to these chips or be able to use these chips. And there's been all these concerns about can Nvidia ship directly to China? And then there's been reports that, look, regardless of how many blocks you put in place, they'll get access to chips one way or the other, whether that's through surreptitious purchasing or things like that. And so, whether or not Saudi Arabia is able to get hundreds of thousands of chips and then, they somehow end up being used by China is part of this equation. And so there have been some lawmakers who have said, look, we got to put the kibosh on this. Let's, maybe take it down a notch. And others who have said, no, let's move full throttle. And so, part of that has to do with the $1 trillion that Saudi Arabia said that they were going to invest in the U.S. Although, until it happens, it happens. It's basically, any kind of deal. And so, I think that that's going to become an ongoing discussion as to the security issues here. But it's also part of a larger push for sovereign AI, which is where countries get to build out their own AI infrastructure, not necessarily having to rely on companies in other parts of the world. The closer you are to a data center, the less latency, the better performance, and so, plus if a country says, hey, we're not going to work with you, we don't want you to have access to this, well, I've already got my stuff built up for now. And so it is part of this broader kind of move. So there's generally a lot of moving parts in AI, but this in particular seems to be even more, I guess, complex.
Yep, a lot of threads. Dan, thank you. Appreciate it, sir. Now time for some of today's trending tickers. We're looking at Kraken, Chipotle, and Lazy Boy. Going to start off with Kraken, the crypto exchange filing for a U.S. IPO. It would be the latest of a slew of big players in the space going public this year, including, of course, Gemini. You had Bullish, Circle. We actually asked Kraken CEO Arjun Sethi about a potential IPO at our Invest event last week. Here's what he told us.
Look, I think the best way to run a company is to be prudent and disciplined, first and foremost, and also who are your customers and who do you cater to. So we've got 3 large constituents, and what we want to be able to do is talk to them about we're financially sound. We know how to have our own risk management on how we run our company. We have enough capital on our balance sheet today as a private company, and that we don't race to the door as quickly as possible. The fear of missing out because everyone else is doing it. And so I think what's good about these companies coming out first is that they are educating the market on what's good and what's bad, what margin looks like, how do you make money, et cetera. I think for us, we're going to do it how we think about what public markets mean, in terms of access to capital or trust when our clients want it.
And joining me now to discuss, we've got our very own Brooke DePalma. Brooke, so Kraken filed confidentially for U.S. IPO. Bloomberg citing sources saying they're looking to go public as soon as the first quarter of next year, seeking to raise new funding at about a $20 billion valuation.
It definitely comes at an interesting time when we've heard about so many companies within this space go public. You mentioned a few at the top. We had Bullish and Gemini. Let's take a look, though, at how exactly they've been performing. And frankly, it's not that great since their IPO. Bullish is down more than 60%. We have Gemini down nearly 70% as well. And Circle, another one, that company mostly flat now after the company went public earlier this year in July. Also, this comes at a time when crypto isn't doing too hot either. Crypto is now below, or rather Bitcoin is now below 90,000, that key threshold, after soaring above 126,000 just a few months ago. And so definitely an interesting time within the markets, interesting time for specifically this type of company in the public markets.
All right, next up, this is right in your wheelhouse, of course, Brooke. Chipotle could see some upside from here, according to Loop Capital, while the analysts lowered their price target to 54 a share in a recent note. That is still over 70% upside from where the stock is trading right now. The analyst saying shares are substantially undervalued following a recent sell-off. Brooke, on this one, the analyst talking about how the fast casual chain, these idea that maybe losing some core customer base, that 25 to 35 age demographic visiting restaurants less. In our view, they say this narrative undoubtedly has some merit, but is overblown, they say.
Yeah, and it to be specific, it's funny because Chipotle was the first consumer company facing to really flag this up against Gen Z, student loan repayments, new prices. They're looking to get into the housing market. So they sort of flagged, they were the ones that raised the alarm about this Gen Z. But then others mentioned it as well. You heard Sweetgreen, you heard Kava sort of mention this decline in the Gen Z consumer as well. And that certainly raised flags as well. All of those companies of which saw, lower same-store sales growth than they did year over year. But if you take a look at the valuation of these companies and how much they've lost in the past year. Look at it, say Chipotle, for example, since last year, it's down more than 47%. The stock now trading at $31. And this was a company that just last year, I covered the stock split of 50 for 1. This was a company that was doing absolutely bonkers. It was doing so great in the market because it really thought to have this value perception where you can get more bang for your buck. Now to see them losing it just a bit, it's definitely interesting. Whether or not a good time to get in, it seems like this analyst thinks so.
All right, finally here from burritos to furniture, let's talk about Lazy Boy. Those shares soaring today. The furniture company topping revenue and earnings estimates, raising its quarterly dividend, issuing upbeat guidance, plans to exit its non-core businesses. Do see KeyBank calling the results encouraging, and just looking at how the street feels about this one. 2 buys, 1 hold, no sell ratings, average target 42.50.
Pretty minimal coverage there though, but this was the biggest move that the company has seen in terms of stock performance in 17 months. And I was looking for some rhetoric on the call about how exactly it's winning in this sort of environment where we're hearing other companies like Home Depot flag about this really cautious consumer right now. And they said that they're sort of leaning into the ability to be agile, hone in on their execution. They also said that they rebranded as, get this, Josh, More Than Your Grandmother's Recliner. And that seemed to have done really well for them as well. They also make about 90% of their product. It's made here in the US. So yet another company that's really been able to offset these tariff discussions that have really hit furniture companies hard over the past few months, ever since April. And really they're leaning into this idea of this consumer of Gen X and millennials. And I wrote a story in Yahoo Finance today about Lowe's CEO and their performance today. That stock was up last time I checked. And it's just interesting, this furniture company really keying into millennials and Gen X, not the Gen Z customer. Because right now, what's the average home buyer age? It's like 40 to maybe even 59.
It's moving up, yeah.
It's moving higher. And so it seems like Lazy Boy knows who exactly is in the housing market right now.
All right, thank you, Brooke. Appreciate it. Well, options traders not only making moves on the recent pullback in major equity indices, but are also gearing up for the highly anticipated third quarter results from Nvidia. Cameo Capital managing partner Jim Struger joins me now to trace the trading action in the options pit, sponsored by Tasty Trade. Jim, as always, great to see you. We've broken some key technical levels here, Jim, on the SPX, on the SOX. How do you want to be positioned into year end, Jim? Maybe start there. I mean, do you look at these market moves and say, okay, I want to be positioned more defensively into year end, Jim?
Well, can I answer that after Nvidia reports?
You sure can. That would be fair, Jim.
Listen, we frankly, to keep it simple with a nice rule of thumb, spot VIX over 20, VIX futures curve inverted relative to spot well into 2026. Until or if we see spot VIX back below 20, we think it makes sense to be a little bit defensive into year end.
Since October 1st, Jim, since the quarter began, it's healthcare that's been really carrying the load here. I'm curious, do you see that continuing?
Yeah, look, everything you've just talked about with your previous guests is AI related. That's really the investing world right now. Healthcare, more or less, has been left for dead over the last bunch of years. If you take a look at XLV, the spider healthcare ETF going back to 2021. It's up about 10%. The S&P 500 over the same time, closer to up 50%. And yet there is increasing interest, we think, with AI and related catalysts coming into the healthcare space. Lilly recently partnered with Nvidia. They're going to build a supercomputer for AI, for drug discovery, right? That's kind of a big deal. And there's some interesting data points from Menlo Ventures, venture capital firm, that's saying that the healthcare industry is deploying AI at 2.2 times other industries, and also about 85% of the deployment is going into smaller caps. So other than Lilly, take a look at Pfizer, take a look at Merck. These stocks, frankly, have been left for dead, and some implementation of AI, perhaps some M&A in the space, could really bring interest to healthcare broadly that hasn't been there for many years now.
And Jim, you mentioned Nvidia. Earnings on deck. I think fair to say, Jim, right? The most highly anticipated print of the season. What do you see, Jim? What do you expect?
Well, first of all, you're absolutely right. I mean, the reality is that Nvidia touches every sector. It's not just a semiconductor company anymore. It's not just about the tech sector. It's really about everything. Because if you scan out and you look at infrastructure spend as it relates to AI and energy, utilities, energy, industrials, we just said healthcare, sort of everyone tags along with Nvidia. So in terms of what the market is seeing, options market right now, pricing about a 7.6% post-earning move. That's below the average over the last couple of years, maybe a little bit surprising, which is closer to 8.2%. The realized move, though, over the last couple of years is closer to 6%. So when we see something like this, a structure in the listed option market that we like to use is an iron condor to position for the actual realized post-earnings move in Nvidia stock to be less than what the option market is implying.
And finally, Jim, I want to switch gears. I just want to talk about crypto a bit. I'm looking at Bitcoin. We hit 126 in October. Now we're back to 89 here. What do you make of the move, Jim? What do you see ahead?
Well, obviously it's gotten hammered today, down about 5% Bitcoin anyway. One way we like to play this is via strategy, which is really the largest Bitcoin treasury company, symbol MSTR, down about 10, 11% today. So it's getting beat up along with just about everything else in the space. But one way we like to play this looking out into February of next year is via a position something like a February 2026 135 270 risk reversal. So what we're doing in this structure is we're selling that 135 put. You need to make sure from a risk perspective, you're selling it in size that equates to the amount of stock you would be put down there. If by chance MSTR is 135 or lower at expiration, you turn around, you buy a 270 strike call, you do that whole package for a small credit. At least you could do that earlier in the day. So consider that pricing indicative. But that really represents our view that Bitcoin and the likes of MSTR, which is highly correlated with the price of Bitcoin, are at or near a bottom here. And we can exploit the listed option market, exploit elevated implied volatility of puts relative to calls to structure a position like this and have long directional exposure out to February of next year.
Jim, always great to see you. Appreciate your time.
Thank you.
We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.